All right, let's get right into it. Today, we're jumping into the fast lane, the high-speed world of scalping. We're going to show you how to take a classic tool, the Stochastic Oscillator, and basically tune it up. Think of it like turning a standard family car into a high-performance racing machine that's built for your trading style. Let's get started.
So let me ask you this. Do you ever feel like your trading tools are lagging behind? Because in scalping, timing is literally everything. Using those default indicator settings is kind of like trying to win a drag race while you're stuck in first gear. A lot of traders run into this exact problem, where the signals they get are just a split second too late.
And you can see the difference right here, plain as day. A standard trader might be perfectly happy with a 14:33 setting. It's fine for longer time frames. But for a scalper, no way. You need something way more responsive, like a 5:33. The pace is faster, the signals are right there when you need them. We're not just tweaking numbers here. We're fundamentally changing how the tool performs for you. And this really gets to the heart of the matter, what we're calling the scalper's speed problem. The thing is, the default settings you find on most trading platforms, well, they just weren't built for the kind of rapid-fire decisions that scalping demands. They're designed for stability, not for pure, unadulterated speed.
Just so we're all on the same page, what exactly is scalping? Well, it's all about making money off of tiny little price movements. And to do that, you're often making a whole bunch of trades in a single day. You're in, you're out, it's fast. And that means your tools have to be just as sharp and quick as you are.
So, what's the fix? Let's get straight to the good part. It's time to pop the hood and give your engine a serious tune-up with some new default settings. And the best part is, this is something you can apply to your own trading, like right after this.
Okay, check this out. The core change is actually pretty simple. We're ditching that slow 14-period setting for something much quicker, like a 5 or a 9. And look at the overbought and oversold levels. Instead of the standard 80-20, you can shift to 85-15 if the market's going crazy to avoid false alarms. Or if it's just ranging, you can use 70-30 to catch more of those smaller moves.
And here's a little pro tip for you. Inside your stochastic settings, you've got to choose the exponential moving average, the EMA. Why? Simple. It puts more weight on the most recent prices, which makes it react way faster to what the market is doing right now. And for a scalper, that kind of speed is absolutely non-negotiable.
But, a great race car driver doesn't use the same exact setup for every single track, right? Of course not. The best traders adapt. So the next big thing is learning how to adjust your settings for different market conditions. Think of it like changing your car's tires, depending on if the track is wet or dry.
Your time frame is basically your racetrack. As you can see here, if you're on a 1-minute chart, you need a really short period, somewhere between 5 and 9, just to keep up. But then, let's say you zoom out to a 5-minute chart to confirm things, well, you can afford to slow it down a bit to a 14-period setting to get a more stable, reliable signal. And believe it or not, the time of day matters too, a lot. The Asian session is usually pretty low-key, low volatility. So you can use a slower setting like 21.5 to filter out all the random noise. But then, when the New York session kicks in and things get wild, you need to tighten everything up to something like 9.2 to really capture those fast moves. It's all about matching your tool to the environment. Okay, so we've cranked up the speed. We're flying now. But with more speed comes more risk. And in this case, we're talking about the risk of false signals. So the big question is, how do we build in some safety features without slamming on the brakes?
Look, faster settings are amazing for getting you into trades quickly. But let's be honest, they can be noisy. The real trick is to filter out that noise effectively. So let's walk through 3 really powerful methods you can use to confirm your signals and seriously improve your accuracy.
First up, we have something called the double threshold method. And as this chart shows pretty clearly, it dramatically cuts down on those pesky false signals compared to just using the old standard 80-20 levels. It's a simple little tweak that adds a surprisingly powerful layer of confirmation.
And here's the real kicker. Research actually shows that this method can reduce false signals by a whopping 37% during high volatility conditions. And that is exactly when scalpers need the most protection. A 37% improvement, that's huge.
So how does this thing actually work? It's pretty genius and it's simple. Instead of just one level, you use 2. So for a buy signal, you're waiting for the stochastics to cross below your primary level of 20, and then you wait for it to cross back above the secondary level of 30. This little extra step makes sure momentum is truly shifting in your favor before you jump into a trade.
Method number 2, bring in volume analysis. Look, a stochastic crossover is good,
But a crossover that happens at the same time as a big spike in volume, that's great. It's the market basically telling you there's real power and conviction behind that move. In fact, studies show this one trick can boost your entry accuracy by 22%.
And our third method is to cross-check with a few other indicators. Now, the goal here isn't to clutter up your chart with a million lines. Not at all. It's about using them strategically. Combining stochastic with the RSI helps you validate momentum. Using it with the MACD confirms your trading with the trend. And pairing it with Bollinger Bands gives you crucial context about volatility. Each one adds a unique piece to the puzzle.
As the Forex Traders Association pointed out back in 2024, the key is selecting complementary tools that provide unique insights while maintaining the speed necessary for scalping. It's all about being smart and efficient, not just piling on more indicators for the sake of it.
Okay, so we've tuned our engine, we've added the safety features. Now it's time for the most important part of all, the test drive. You should never, ever take a newly tuned strategy live without putting it through its paces first.
And the gold standard for doing this is called walk-forward testing. It's a simple three-step process. First, you optimize your settings on about 6 months of old data. Second, you validate those settings on a fresh month of data that the system has never seen before. And finally, you verify how it performs in the live market. This process makes sure your strategy is actually robust and not just some lucky fluke.
For making adjustments in real time, you can use an indicator called the average true range, or ATR. Think of it as a volatility meter. When the ATR is high, meaning high volatility, you can actually lengthen your stochastic periods to cut down on noise. When the ATR is low, you can shorten them to get more responsive signals. This dynamic approach is incredible and can slash false signals by another 30% during big market events.
All right, we've covered a ton of ground, so let's pull this all together into a simple, actionable checklist you can literally use every single day to put these ideas into practice.
Here it is. First, stick to the time frames you tested. Be consistent. Second, use the live ATR to tweak your levels based on what the market is doing right now. Third, be patient. Wait for that full confirmation. That means letting both stochastic lines cross your levels. And finally, the most important rule of them all, always protect your capital with a stop loss.
So there you have it. You now have the complete blueprint to turn a standard, everyday indicator into a precision tool built for scalping. Your engine is tuned, your safety features are installed, and you've got your daily checklist ready to go. The only question left is, which market are you going to conquer first?